You look at your credit card statement, and it feels like nothing you do matters. You pay every month. Sometimes you even pay more than the minimum, yet the balance barely moves, or somehow looks higher than before. That feeling isn't because you're bad with money, or lazy, or irresponsible. It's because the system is designed in a way most people are never clearly shown. In a moment, I'll explain the one quiet detail that makes this feel endless, even when you're retrying. Most people think of a credit card like a bucket. You pour money in, the water level goes down. But credit cards don't work like buckets. They work more like a treadmill that's slowly speeding up underneath you. If you walk at the same pace every month, you're technically moving, but you're not getting closer to the end. If you don't know the speed is increasing, you start blaming yourself for not walking harder. Here's the part almost no one explains in plain English, where your balance isn't just a number you owe. It's a number that's constantly growing in the background through interest, even while you're paying. And the timing of how that interest is added matters more than how motivated you are. This is where most people accidentally make things worse, even with good intentions. Let's use a simple, realistic example. Say you have a credit card balance of $5,000 with a 24% annual interest rate. That's not extreme. It's very normal in the US that 24% doesn't wait until the end of the year to show up. It's broken into daily interest. Roughly speaking, that's about 0.065% per day. That means every single day, interest is being added to your balance based on whatever the balance is that day. Now imagine your minimum payment is $150. You make that payment on time every month. You feel responsible. You're doing what the statement tells you to do. Here's what's quietly happening. A big chunk of that $150 goes to interest that already built up. Only what's left actually reduces the balance. In the early months, that might be $30 or $40. So you paid $150, but your balance only drops a tiny amount. Sometimes it doesn't look like it dropped at all, because new interest keeps stacking on. In a moment, I'll show you why this matters more than people think, especially for your credit score. What makes this worse is that minimum payments are designed to keep you in the cycle, not get you out of it. They're calculated to keep the account current while maximizing how long interest can be charged. This isn't a conspiracy theory. It's just how the math works. If you only pay the minimum on that $5,000 balance, it can take well over a decade to pay off. And you could easily pay thousands more in interest than what you originally spent. This is why it feels like you're doing everything right and still going nowhere. Because from a behavioral standpoint, you are doing what you were told. But from a math standpoint, you're barely touching the problem. Now let's talk about the credit score side of this, because this is where frustration really builds. Your credit score is not a measure of effort, it's a measure of risk. And the two biggest pieces of that risk calculation are payment history and credit utilization. Payment history is the largest factor. Roughly 1/3 of your score comes from whether you pay on time, not whether you pay a lot, not whether you're trying hard, just whether you paid by the due date. This is why one late payment hurts more than people expect. Single missed or late payment can stay on your credit report for 7 years and drop your score by dozens of points, especially if your credit is already fragile. That doesn't mean you're doomed, but it explains why things feel unfair. Credit utilization is the next big piece people misunderstand. This is how much of your available credit you're using. And here's the frustrating part. The system cares about the balance, not your intention to pay it off. You could be paying extra every month, but if your balance is still high compared to your limit, your score can stay stuck. Let's use another simple example. Say you have a card with a $10,000 limit, and your balance is $7,000. That's 70% utilization. From a credit scoring perspective, that looks risky, even if you've never missed a payment. If you pay it down to $6,000, that's still 60%. You made progress, but your score might barely move. This is why people feel like they're running in place. Later, I'll explain what actually helps instead of just working harder. Now combine these two things. You're making on-time payments, which is good. But your balance stays high because interest is eating your payments, so your utilization stays high, so your score doesn't improve much. And because your score doesn't improve, you don't qualify for lower interest rates that would help you escape faster. This loop is the trap, not your discipline. Another quiet issue is timing. Credit card companies report balances to the credit bureaus once a month, usually on your statement date, not your due date. So you might pay your card in full a few days after the statement cuts, feel proud, and then see your credit score didn't improve. That's because the high balance was already reported. This makes people feel like credit scores are random or rigged, when really they're just badly explained. Now let's talk about common mistakes that come from trying to fix this without clear guidance. One is spreading extra money across too many cards. You put a little extra on each balance, hoping it adds up. Emotionally, that feels balanced. Mathematically, it's slow. Interest doesn't care about fairness. It cares about where the balance is highest and the rate is worst. Another mistake is relying on willpower instead of structure. You tell yourself you'll spend less next month. You try to be perfect, then life happens. Car repair, a medical bill, a slow work week. The card gets used again, not because you're reckless, but because you're human. This is why later I'll show you why income changes matter more than motivation. A third mistake is chasing quick fixes. Balance transfers without a payoff plan. Apps promising credit score hacks. Side hustles that sound exciting but burn you out or fizzle fast. These don't fail because you didn't try hard enough. They fail because stability beats speed in personal finance, even if that's not very exciting. Here's the calm truth. Credit card balances don't go down because the system is designed to move slowly unless you change one of three things: the balance size, the interest rate, or your income. Most people only try to change the first one with payments, and that's the hardest lever to pull alone. Income is the part that feels uncomfortable to talk about, but it matters more than willpower. If your margin is thin, every payment feels painful. If your margin improves, even a little, everything gets easier. This doesn't mean you need a second full-time job or some flashy online scheme. Slow, boring income works because it's predictable. For example, someone who picks up a steady $300 a month doing evening delivery. Weekend cleaning, tutoring, or freelancing in a skill they already have is not changing their identity. They're changing the math. That $300, when targeted at one high-interest balance, can do more than cutting every small joy out of your life. And because it's consistent, it actually sticks. This is why fast money is tempting, but boring money wins. In a moment, I'll explain how to turn this understanding into simple actions without overwhelming yourself. First, what to do today. Today is about visibility, not perfection. Look at your statements and write down 3 things only: each card's balance, interest rate, and limit. That's it. It's no shame, no judgment, just facts. This alone often lowers anxiety because uncertainty is heavier than numbers. This week is about targeting, not fixing everything. Pick one card, usually the one with the highest interest or the highest utilization relative to its limit. Decide that any extra dollar goes there, not spread out, not saved for later. Directed. This focus is what makes progress visible, which keeps people going. This month is about improving your margins slightly, not flipping your life upside down. One small, realistic income move or expense adjustment that actually sticks. Something you can still do when you're tired. Something boring enough to be sustainable. This is also when you look into options like hardship programs or interest rate reductions, not as a failure, but as a tool. If this feels slow, that's because it is. Financial repair is slow, but slow doesn't mean stuck, it means stable. Every percentage point of utilization that drops, every month of on-time payments, every small increase in margin is quietly working, even when it doesn't feel dramatic. The reason your balance never seems to go down isn't because you're failing. It's because you were never shown how the system actually works. Once you see it clearly, the shame starts to loosen its grip. You stop asking what's wrong with you and start asking which lever to pull next. You are not behind. You are not broken. You are dealing with math that was never explained to you in a human way. Progress here is boring, repetitive, and absolutely possible. And if you want more calm clarity like this, staying around can make this whole process feel a lot less heavy.